May 6, 2010, started like any other Thursday on the U.S. stock market. Traders were moving assets, screens were flashing green and red, and everything operated at its usual steady hum. And then, suddenly, the floor fell out. This chart tracks the market's total value that afternoon. In minutes, a near vertical plunge wiped nearly $1 trillion off the board. But then, something stranger happened. Half an hour later, the market corrected itself, climbing right back to where it started. Investigators immediately searched for a massive cyber attack or a catastrophic hardware failure to explain the drop. They found neither. Instead, this entire economic panic was triggered by a minor data error. When most of us picture the stock market, we imagine shouting floor traders frantically waving paper slips. But those human-led trading pits are mostly gone. Today, between 60 and 70% of all market trades are executed by automated trading systems, or ATS. These are computer programs living on servers, designed to buy and sell stocks entirely without human intervention. Firms rely on these systems because they process massive amounts of financial data instantly. They execute trades with a speed and efficiency that human brains simply cannot match. So if these programs are built to be perfectly efficient and rule-bound, how does a tiny data glitch create a trillion-dollar vacuum? The sequence of the flash crash began when an automated system executed a massive, sudden sell order. The algorithm itself functioned perfectly, but it was fed flawed real-time data. It processed an execution command based on corrupted inputs, completely failing to account for actual market dynamics. Algorithms do exactly what they are programmed to do. They don't pause to double-check their math, and they lack the human intuition to recognize when a number doesn't make sense. Almost immediately, high-frequency trading systems, secondary algorithms built to rapidly buy and hold assets for fractions of a second, detected this massive sell order and reacted to it. The AI systems weren't broken. The catastrophe occurred because flawless, hyper-fast algorithms perfectly executed logic based on corrupted inputs. As that first algorithm aggressively sold, it artificially drove down the asset's price. That low price became a new data point for a second algorithm, which panicked and sold, triggering a third. A critical vulnerability is that many of these algorithms use incredibly similar settings. Operating without human coordination, they rapidly amplify minor anomalies. A duplicated quote or an inconsistent timestamp instantly snowballs as hundreds of systems react simultaneously. In this homogeneous, high-frequency environment, algorithms blindly react to each other. This turns minor glitches into catastrophic volatility. Today, AI trading systems are significantly faster and more prevalent than they were in 2010. When confronted with the risk of another crash, the instinct is often to demand strict, bureaucratic government regulations dictating exactly how these algorithms are allowed to operate. But research from Maximilian Goman at the London School of Economics suggests that imposing rigid new rules on AI logic is a trap. Overregulation can cause more harm than good by limiting how systems adapt. Goman argues that policymakers are obsessing over the algorithms themselves. They are ignoring the quality of the data those algorithms are trained on and reacting to in real time. As an alternative to heavy-handed government mandates, Goman proposes a framework called voluntary data certification. This dashboard illustrates the concept. Instead of being forced by law, data providers are incentivized to publicly benchmark their data streams. Regulators could also mandate independent stress tests. They simulate anomalies, like missing values, to catch weak infrastructure before an algorithm sees it. Verified, high-quality data becomes a competitive advantage. Traders will naturally migrate to certified providers, allowing the free market to regulate itself through transparency. To survive the ultra-fast future of algorithmic trading, we must stop fearing the speed of the machines and start guaranteeing the truth of the data we feed them.